Between February and November 2024, the gods of modern capitalism didn't just trim their portfolios, they detonated them. Jeff Bezos vaporized $13 billion in Amazon stock in two brutal, perfectly timed waves, the largest concentrated unload of his 30-year reign. Mark Zuckerberg quietly bled out more than $9 billion in Meta shares, month after month, like a man cashing checks while the house is already on fire. Jamie Dimon, the silverback of global banking who had not sold a single share in 18 years, not through 2008, not through COVID, not ever, suddenly dumped 1 million shares of JPMorgan for the first time in his life. Larry Ellison cashed $3 billion in Oracle at the exact top of the AI cloud frenzy. The Walton heirs, who treat Walmart like the family printing press, unloaded $2.3 billion in perfectly synchronized blocks. NVIDIA insiders, drunk on the greatest chip rally in history, still found time to puke $1.2 billion while smiling for CNBC cameras and whispering, "The best is yet to come." This was not diversification. This was not tax optimization. This was not personal liquidity needs. This was the smartest, most ruthless, most battle-scarred operators on planet Earth, sprinting for the exits in perfect formation, using the exact same choreography they executed in 2007, right before the world lost $16 trillion and the S&P 500 fell 57%. These men do not panic, they do not flinch. They have survived every crash since the dot-com bloodbath. They sit on oceans of real-time data the public will never see. Daily sales trends, loan default curves, margin compression forecasts, competitive kill shots forming 3 quarters out, and every single one of them at the exact same moment looked at that private data and decided that the greatest bull market in modern history had reached its final inning. The total haul from insider sales in 2024 hit $464 billion, the second highest year ever recorded. The only year that beat it, 2007, with $650 billion right before the sky fell. History is not repeating, it is rhyming in screaming capital letters. And the rhyme says we have somewhere between 6 and 18 months before the cascade begins, before the leverage unwinds, before the commercial real estate loans blow up, before the corporate bond maturities at 7% interest rates turn profitable companies into Chapter 11 filings, before the $950 billion in margin debt becomes forced liquidation fuel, before the Buffett indicator at 185% and the Shiller Cape at 34 do what they have always done, revert to the mean with violence. The people who built Amazon, Meta, Oracle, JPMorgan, Walmart, and NVIDIA from nothing are not waiting around to watch it happen. They are converting paper wealth into cash, into hard assets, into anything that isn't priced for perfection, because they know perfection is about to be murdered. This is not a prediction. This is pattern recognition on a scale very few retail investors have ever witnessed in real time. The smart money has already voted with trillions of dollars in sell orders. The only question left is whether you will be the one holding the bag when the music finally stops. The pattern is merciless, and it has never once lied in 50 years of recorded data. Pattern 1. Insiders always begin their exodus 12 to 24 months before the final market peak, never at the exact top, because they are not gods. They are predators who want distance between their last sell order and the first screams. In 1987, they sold like madmen all spring and summer. The market peaked in August and detonated in October. In 2000, they hammered the sell button through Christmas 1999, while CNBC threw parades for Pets.com. The NASDAQ crowned itself in March 2000 and then bled out 78% over the next 30 months. In 2007, the sell orders flew so thick the tape couldn't keep up. The S&P kissed 1565 in October 2007 and then free fell to 666 by March 2009. Every single time the insiders were already in cash, sipping something expensive, watching retail investors and hedge fund tourists ride the last elevator up. Pattern 2. The sell-to-buy ratio, the cold, mathematical heartbeat of elite fear. A normal, healthy market hums along at 2-1 or 3-1. Insiders sell a little, buy a little, life goes on. When the ratio punches above 8-1 for more than a quarter, the guillotine is already being sharpened. It hit 9-1 in 1987, 11-1 in 2000, 10-1 in 2007, and in 2024 it closed the year at 9-1, with individual months spiking to 12-1. There has never been an exception. Pattern 3. The most overvalued sectors bleed first, because insiders in those sectors can literally watch the mania from the inside and time their escape to the day. In 2000, it was tech executives selling while Yahoo traded at 300 times sales. In 2007, it was financial CEOs dumping before anyone outside their boardrooms knew the word subprime would become a curse. Today, it is once again tech, Amazon, Meta, Oracle, Nvidia, and financials, JPMorgan, leading the stampede. Pattern 4. When the legendary long-term holders, the builders, the founders, the people who have clutched their stock through hell and high water for decades, suddenly flip into net sellers, the top is not coming, it is already here. Bezos held Amazon through the dot-com cratering that took the stock from $113 to $6. Zuckerberg held Meta when it lost 77% in 2022, and the metaverse was a punchline. Jamie Dimon held every single share granted to him since 2005, preaching alignment and skin in the game like a religion, until 2024, when he broke the vow for the first time at age 68. When these titans, who have seen every trick the market can pull, decide that forever has an expiration date, you do not argue. You run. Pattern 5. Once annual insider selling clears $400 billion are inflation adjusted, the stock market has never, not once, made a new all-time high within the next 24 months. It either crashes hard or it enters a multi-year grinding bear that chews faces off. 2024's $464 billion is already the second worst reading ever. If the pace holds into 2025, we will blow straight past 2007's record and write a new chapter that historians will study with the same dread they reserve for 1929. These 5 patterns are not loose correlations. They are interlocking steel beams holding up a single brutal conclusion. The greatest transfer of wealth from the uninformed to the ultra-informed is already in motion. And the clock is ticking louder every week. The billionaires are not guessing. They are reading tomorrow's obituaries today, written in data streams the rest of the world will only see when the bodies are already cold. They watch the Buffett indicator glowing radioactive red at 185%. The total U.S. stock market, now worth nearly twice the entire annual economic output of the country, a level higher than 1929 and 2000 combined, a valuation that can only be justified by the religious belief that profit margins will stay at all-time highs forever, while GDP explodes 60% in a handful of years. Both assumptions are delusional, and the insiders know it. They watch the Shiller-Cape ratio sitting at 34, a height reached only 3 times in 150 years of recorded history, 1929, 2000, and the brief 2021 fever dream, each followed by losses of 50 to 89% within 36 months. They watch NYSE margin debt kissing $950 billion, a monstrous tower of borrowed money that will turn into forced selling the moment prices crack even 15%, the same mechanism that turned a 2008 correction into a civilization-threatening heart attack. They watch $4.7 trillion in corporate bonds, issued at 2-3% during the ZERP orgy, roll over into a 6 to 8% interest rate environment, a slow-motion train wreck that will turn thousands of zombie companies into bankruptcies and their bonds into confetti. They watch commercial real estate vacancies locked permanently at 40–50% in every major city, with $1.5 trillion in office mortgages coming due over the next 36 months at triple the interest rates the buildings were underwritten for, guaranteeing a bloodbath that will flow straight into the balance sheets of regional banks and then into the money center giants like JPMorgan. They watch federal interest payments already eclipsing the defense budget at $1.2 trillion per year, with the Congressional Budget Office openly admitting the trajectory becomes mathematically impossible by 2028–2030, unless Washington chooses between default, hyperinflation, or austerity that would make Greece look like a spa day. And most crucially, they watch their own proprietary dashboards, the real ones, not the quarterly propaganda released to analysts, showing decelerating daily active users, flattening ad load growth, shrinking AWS take rates, rising credit card delinquencies in the bottom income quintiles, surging loss reserves on commercial loans, and AI capital expenditure plans that now exceed projected incremental revenue by factors of 3 or more. These are not public data points. These are leading indicators that hit executive inboxes every single morning, and every single morning in 2024, those indicators whispered the same 4 words: get out while you still can. So Bezos moved to Florida, not for the zero state income tax. He could have done that in 2005, but because Florida has no capital gains tax either, saving him another $1.5 billion on the $13 billion unload. Zuckerberg accelerated his 10b501 plans to the fastest cadence of his life, selling practically every week the SEC would allow. Dimon finally broke his sacred vow and sold the moment his own internal models told him the commercial real estate provisions would begin eating alive the earnings story in 2025. By 26, the message is identical across every C-suite. The macro backdrop is a minefield. The micro backdrop is deteriorating faster than the headlines admit, and the wall of worry has turned into a cliff. Cash is not trash right now. Cash is oxygen, and they are all buying as much of it as the market impact will allow before the rest of the world figures out the tanks are empty. The cascade has already begun. It just hasn't reached your street yet. When the first real crack appears, maybe a hotter than expected inflation print that forces the Fed to hike instead of cut, maybe a major regional bank quietly seized on a Friday night because its office loan book finally imploded, maybe Nvidia guides 30% below the lowest whisper number because the AI training bubble popped overseas. The $950 billion in margin debt will ignite like dry tinder. Forced selling will hit the Magnificent Seven first, because that's where the leverage is concentrated. A 20% drop in 6 weeks is entirely plausible. It happened in 1987, 2000, 2008, and 2022. Once the indexes are down 20%, the robo-advisors and risk parity funds start de-risking automatically, selling bonds and gold along with stocks, creating the rare everything sell-off that crushes even the safe assets. Credit spreads blow out, liquidity vanishes, and the corporate bond market freezes exactly when those $4.7 trillion in maturities need to roll. Investment-grade companies survive by drawing revolvers and slashing capex. High-yield companies simply file Chapter 11 in waves. Unemployment spikes from 4.1% to 8% in 12 months, as layoffs spread from tech and finance to retail, transportation, and construction. Commercial real estate prices finish their 50–60% decline that started in 2023, wiping out another cohort of smaller banks and forcing the FDIC to tap its credit line with Treasury for the first time since 2009. The federal deficit explodes past $3.5 trillion a year as tax receipts collapse and emergency spending ramps up, pushing interest payments toward $2 trillion and making the debt spiral visible to even the most optimistic bond vigilantes. The dollar cracks 15–25% against real assets. Gold surges past $4,000. Bitcoin does whatever Bitcoin does in chaos. And the billionaires who sold in 2024 sit on hundreds of billions in dry powder, waiting for the fire sale. They will buy the same companies they just dumped, but at 40–60 cents on the dollar, exactly like they did in 2009–2010, exactly like their predecessors did in 1974–1938. Every other generational bottom, wealth will not be destroyed. It will be transferred on a scale we have not seen since the Great Depression. The losers will be the passive index crowd who kept dollar cost averaging all the way down. The 60–40 portfolios that discover bonds can crash alongside stocks. The crypto maximalists who thought this time was different. The private equity barons holding overvalued 2021 vintage deals that can't refinance. And every leveraged player who believed the Fed put was invincible. The winners will be the people who listened to the only vote that has ever mattered. The revealed preferences of the men who built the system and know exactly when it's about to break. You still have time, but not much. Convert speculative positions to cash or hard assets. Raise stopping levels, shorten duration, build a war chest, because when the music stops, there will be no chairs and no sympathy. The insiders have already taken theirs. The pattern is locked, the data is screaming, and the clock is no longer ticking. It's striking midnight. See you on the other side, richer or poorer, but definitely wiser.